Welcome to Ask the Experts. I'm Jill Schlesinger, editor-at-large of CBSMoneyWatch.com, and I'm joined by
Jack Otter, executive editor of CBSMoneyWatch.com.
And this is going to be a great program. We're going to be talking about real estate and mortgages and refinancing and all the things that are everything housing. And we have a special guest star to bring into the conversation. She is Ilyce Glink, who's joining us via Skype. Ilyce is an award-winning, nationally syndicated columnist. She's a book author, radio talk show host. She owns and operates a whole bunch of websites. ThinkGlink.com is one of the biggies. She speaks a zillion places. She's just all around money real estate chick, Jack.
And she informs us. I mean, she comes up with this stuff that I didn't even know existed, and she's got it off the top of her head.
Amazing.
Yeah.
It's just amazing. Ilyce, thanks so much for joining us.
Oh my gosh, after that introduction, I better up my game a little.
I'll tell you the truth. Don't forget that you were supposed to be here live in the studio. We're very sad that you're here via Skype, but we're happy that you're here at all. But that just means that you're not off the hook for buying lunch next time.
I absolutely will buy you lunch next time. Promise.
Actually, did I say lunch? I meant dinner and drinks, too. And now she agreed so quickly.
Yeah.
That was a bad negotiation, wasn't it?
Well, she's in sales, so she understands this stuff.
She knows it. She knows it. Elise, we are just inundated with calls and chat room questions, so let's just dive in. We're going to take some questions right now. He and his wife are contemplating buying a home, but they want to put less than 20% down. Could we have a sound effect for that? Like, wah, wah, wah. I don't like putting less than 20% down. I think that's a really good rule of thumb because there's some rules of thumb that you should stick to.
Yeah, I mean, I guess you could have a situation where you had really good cash flow. Maybe you're recently married. As single people, you were crazy nuts. You didn't put any money away. Now you got good cash flow, solid job. And you know what? You want to take advantage of these rates and these prices, and you can do it. I think it has to be a very specific situation. You need to ask yourself, why don't I have 20%? And can I really afford this property if I don't?
Right. And is there any way around having to pay PMI with less than 20% down? I don't think so. At least they used to do those 90-10 loans that you could avoid PMI with, but they don't do that anymore, do they?
No, they really don't. And what most people don't understand is that if you do an FHA loan, which is now 30-40% of the marketplace, FHA is basically PMI for life, no matter how much you put.
Really?
So if you've got credit and the only way you can go is with an FHA loan, you'll be paying a very expensive amount for basically what's their version of private mortgage insurance. They call it MI instead of PMI, but it's very expensive.
That's very clever of them, changing it from PMI to MI. That's a fabulous marketing vehicle, isn't it?
It's not private.
It's
FHA.
Exactly. It's GMI, Government Mortgage Insurance. Valerie wants to know, what bank is offering the best cash out refinance? I would like to get equity out of my home. Haven't we seen this movie before, Valerie? And I am retired, and I need to know that I will not get scammed by banks that keep changing names and don't follow procedure. I've read numerous negative things about bank. I just bleeped that out. So I need to know, what bank is the best? Do I need to hire a lawyer? Valerie from Coral Springs, Florida.
Valerie, let me start by saying if you're retired and you have no income, you're not going to qualify for a cash out refinance.
Okay, so, there you go. That's easy.
You would, if you had full equity in your house and no mortgage at all, you might have qualified in the past, and I would have recommended a reverse mortgage, which would have given the cash you need, not have to pay anything back. You still have to pay your taxes and insurance until you sell the house or you basically die or move out of it permanently. But what's happened in the reverse mortgage market, and I've written about this on MoneyWatch a little bit, is that there's been a tremendous number of seniors who are defaulting on those loans. They're not paying their taxes and insurance. The houses are going into foreclosure. The lenders are completely unprepared. Their business model didn't help this. Fannie Mae has gotten out of the reverse loan market altogether, which just leaves the FHA loan version of reverse mortgages. And there's just been all kinds of ridiculous assumptions based on how much the property would be worth. I took a look at one of those amortization sheets, and it basically was counting on properties going up in value by 4% a year. This was in 2009 and 2010 when, as we all know, the housing market collapsed. And so there's just been all kinds of strange and false assumptions. And the result is that some of the biggest reverse mortgage lenders in the country are now out of the business. So I don't think you're going to have a very good, easy chance of getting a cash out refinance. It's going to be very hard. You might try for a home equity line of credit.
Or a loan.
No, if she doesn't have the income to qualify, she's not going to get a loan. that the home equity line of credit may have slightly different requirements. It's a much smaller amount of money you'll be able to, but you might be able to get that.
And
the whole topic is a little, and Ilyce has touched on it, it's a little scary to me. If to borrow money when you don't have an income and you don't see the stream for replacing it. I mean, it's one thing with the reverse mortgage, you're essentially selling your house to the bank and
taking the money now
until you die.
Right.
One thing she should look into is a downsizing. I don't know how big
that's
her house
what I'm thinking. Sell the house.
But let's take that money out, but don't give part of your house to the bank in return for it. Just sell the house, get a smaller one. Now the problem is you're better off in a falling market upsizing rather than downsizing. It's not a great situation.
Yeah, but
still,
if you need the money, you need the money.
Yeah.
By the way, someone in the chat room whose name I cannot possibly pronounce says that with an 80-10-10 you don't pay PMI. But I don't think they do those loans anymore, the 80-10-10s. I thought they weren't doing them, Ilyce.
No, they're really not. Yeah, the 80-10-10s or 90 a 90-10 was out there as well. They're basically called piggyback mortgages, and they're really just not doing them anymore. Lenders are very, very nervous about it. The only time you're seeing them is with higher-priced mortgages. And so Bank of America, in trouble, big news every day, kind of a bank, Bank of America was doing it for some of their better customers who are buying, like, say, a $600,000 or $700,000 house, and they would put 20% down, get a $417,000 first mortgage, which was within the conventional realm, very cheap, and then a second mortgage or home equity loan on top of that, but they were still requiring 20-30% down. So it's not quite the same thing.
And brokerage firms for a while were doing these great loans where they were getting in sort of the housing slash, it was fascinating. It was like a margin loan against against your investment account. And people just thought it was the same thing. I'm like, oh, you've just pledged your securities. You've actually just told them you'll give them your retirement account if you default. But we don't do it.
And then stocks and housing fell.
Yeah,
right?
exactly.
Jill, those have come back, by the way. I was hearing that Merrill, which had the original one, the Merrill 100 meaning 100% loan, and you would pledge your assets and all the rest. I believe Merrill Lynch has actually come back with a second round of that, and some of the other investment companies as well are doing these loans for their high net worth clients.
That's nice. Merrill Lynch could do that, and we use their old Countrywide loan documents. They could repurpose it, which is great. All part of the Bank of America family.
Robots to sign them.
Then and then what we can do is we can blame the chick when things go south,
That's
as
right.
my colleague Jack would say.
Today, Sally Krawcheck.
Yeah. Okay.
I'd like to point out she made money for them last year.
I'd like to point out that, why she needs this Surus working for this idiotic company at this point in her life, and she's had a whole career where she's done great things. So Sally Krawcheck was brought in by Ken Lewis from Bank of America in 2008 or 9. I think it must have been 9.
Yeah.
Because she's been now,
Probably,
she's 2 years. And she came from Citi. Is that right?
She was at Citi. I forget if there's anything between those two.
And she was
she left Citi.
She left Citi,
some interim thing.
and then she actually, her former career was spent at DLJ. She's got real chops. She's a real person.
Well, we should say her claim to fame was she was an honest bank analyst when they were far and few between.
Amazing.
That's how she was very good and honest, and she moved up quickly.
And, she has now reduced the ranks of women on Wall Street to 3.
But what to me is really amazing about this is she inherited problems created by Stan O'Neill at Merrill, by Angelo Mazzillo at Countrywide, by Ken Lewis at Bank of America, all these horrible problems, and she gets canned.
I know. I'm telling you, she needs this job like a hole in the head. I would have been see you later. Oh, and not to mention, by the way, the whole Carol Bartz thing. I feel like it's a bad day for women, Jack.
Yeah,
Can you defend our honor?
Well, and also Carol Bartz, she inherited problems. Maybe they should have taken that offer from Microsoft at 33.
Think? I don't know.
It
seems like we've lost 60% of our value since then.
So both these women were basically charged with solving problems they didn't create. They failed to do it. I mean, I think they're different situations because Bartz, boy, that was what would you do in that job? I mean, on the one hand, she probably made a lot of errors. On the other hand,
whatever. It's a little bit of a sinking ship there.
Yeah.
So now, but not our Sally. I'm going to defend Sally until I find out she did something horrible. Then I'll throw her under the bus.
She was a little rude to me.
She was.
I am defending her. Yeah.
Is that right?
Yeah.
Wait, guys, she made money last year, a lot of money for the bank.
Well, but I think this is the deal. I agree. Merrill Lynch actually did make money last year. So Merrill Lynch made money, but. No kidding. Every money, you know what I'm saying? Every brokerage firm did. Here's the thing. She's not Moynihan's gal. He did not bring her in. So I think this is my whole theory on this. I met Brian Moynihan. And Brian, if you want, I would be happy to interview you anytime. So I like Brian. He's a good guy. alum of Brown
Oh,
University.
okay.
So, of course, we like that. But here's the thing. I think he was like, you know what? I'm getting completely slammed for every single thing that happens at this bank. If I'm going to go down, I might as well have my entire team. I might as well have my team, the people I want. I didn't pick her. I didn't pick this one. I'm going to go out and bring my team together. I'm going to do the best that I can. I think it's foolish because I don't think you let good people go, but maybe he didn't like her. Maybe he doesn't like women. I don't know. I'm just saying, I don't know.
Listen, you want to talk who Bank of America should get rid of? They should get rid of all of their third-party consultants that are the ones hindering the loan modification process.
Oh, yeah.
Process. They should retrain or fire the 10,000 or 15,000 people they hired to actually take homeowners in distress calls. They should actually start to buck up and do the right thing when it comes to this kind of stuff. Like, there are things that Bank of America could do better, just like there are things that Wells Fargo is trying to do better. Wells Fargo just is embarking on a 36-city tour where they're flying in 200 people so they can have face-to-face interactions with thousands of homeowners in every city. Bank of America has one. They called me and they asked me if I would promote it. They had one this year.
And a meeting. I mean, the thing about the Wells Fargo is also they need a lot more time because they need to get that covered wagon to the play. All the location does take a lot longer. Okay, now Louise wants to know, what do you recommend as a down payment mortgage ratio, even if I have cash to purchase something outright? Jack, we talked about 20% down, but this is one we need a little more information, I think. But let's assume that let's make up a Louise story. We'll do two different scenarios. Louise is single and she makes $100,000 a year. She's got $400,000 saved. She could deplete her entire brokerage account and buy a townhouse outright. Should she do it?
I would say no. We like liquidity on this show. We always do. So when you have that liquidity, to exhaust it at a time when you could get free money, as Ilyce said, why would you do that? I wouldn't do it. Scenario, then you go to scenario
I'm going to
two.
give you another scenario. Okay. So Louise has $4 million. She sounds quite good looking, doesn't she? She's got $4 million in her brokerage account, and her son is just moving to New York, and she's going to buy him and her. She's going to basically do it for both of them, a pied-à-terre, and it's $300,000. Can she pay cash for that, please?
Absolutely.
Okay. And last but not least, Louise is married. She's got $1 million. She's going to buy a $400,000 place. They have good cash flow, but they are 5 years from retirement.
Ooh, I think on this one, given the price of the loan, 10 years from retirement, 5 years.
5 years from retirement.
Yeah, I hate taking that loan into retirement. The ghost of Eric Schoenberg is talking to me in one of my ears here. Maybe, do we want to do a 7-year ARM with knowing that you have the cash flow to pay it off?
How about a 30-year and you just start paying it down like crazy?
But you get a better rate, though, on a shorter one.
Do the 15-year. Do the 15-year because you can get a 15-year at 3.25% or even cheaper. She can pay it off at any time. Why would you pay the extra 0.5% just to have a 30-year? It doesn't make any sense.
Now, the only reason I would ever to have her do a 30-year is for flexibility, but that's it. There's no other reason why.
$1 million or $1 million.
I know. She doesn't need flexibility. Okay. Yanni is trying to sell. She says, my year-old townhouse has been listed since April of 2011. Okay, that's like 5 minutes ago, but okay. Sally, who is running the board, Yanni has sent us a link to the online listing of her home. Let's pull this up. Is this it? This yellow house here? Oh, that seems
Looks
quite nice.
Yeah.
Where is this? Anyway, what should she do to market this house? Ilyce, you're a big fan of the whole staging thing. Talk about what that staging is all about.
Staging just means watching any show on HGTV and making your house.
I love it.
I have actually done videos, before and after videos, on my YouTube channel, which is Expert Real Estate Tips, or you can go to expertrealestatetips.net. We have 325 videos. You can just watch us stage home after home if you like. But seriously, I think staging is sort of the first thing because you really have to design the experience for your buyers these days. It's not just enough to have it be neat and clean. They have to see what you want them to see, and staging allows you to do that. You're putting the focal point exactly where you want it, whether it's the fireplace or the view out the window or the roominess and the light, bright feeling that you get. Whatever it is, you want to do that, and staging is a very interesting way to do that. And then I think it's about price. and being the most realistic that you can even imagine about price. Because we talked about earlier, lowering price just never works. It's not working in this marketplace. And so you really, if you want to sell it and get out, you have to undercut almost everybody else in the market. And that's where people are running into trouble, because when you have foreclosures in your neighborhood, it completely throws all of your numbers out of whack, and you're not going to be able to underprice a foreclosure, or you might, but you're not going to be walking away with any money in the bank. So before I can give her more advice, I mean, things like set up your own website, find a broker who's going to, syndicate your listing all over the place to Truly and Realtor.com and their own websites. All that is standard in today's industry, but you really have to basically step out on your front stoop and figure out how many foreclosures you can see from your doorstep, so you figure out what your pricing strategy is that way.
Here's another question. This is interesting. Experts, I want to purchase a home, but I'm currently making installment payments on back taxes to the IRS. What should I do? I'm kind of thinking, pay back the IRS, and then we'll deal with your house. I mean, do we need to do all these things at once?
They can't.
They can't qualify for anything anyway. They got to pay this. They got to pay back the gov. Uncle Sam always gets his money.
Once you have a tax lien that you're paying back, your credit score is probably in the low 500s, if not lower than that. So tax liens are really at the top of the heap. And until that's paid off, and then you've got another 2 to 4 years of rehabilitating your credit score, getting any kind of loan is going to be next to impossible. And if you have the cash to pay cash, then you might as well just pay off the tax lien tomorrow and start rebuilding today.
There you go. Mina, on the other end of the credit scale, says, I have no debt except for a mortgage, no credit card or car loans. I have an 800 plus credit score.
Sweet.
I qualified to purchase a $430,000 rental property. Now, keep this in mind, Jack. She's got money. She's been putting it into the 401k for the past 18 years. It hasn't been going up that much. And now I'm thinking about rental property for retirement. Should I get into real estate? What are your thoughts, Dr. Otter?
So this is an income-producing property.
Correct.
Yeah, okay.
And already qualified, got it going.
I'm going to do a little ad for our website and direct her to read 2 posts by Kathy Christoff. One about all the headaches of being a landlord, and the other one, tricks to know if you're going to do it. I mean, it's a very specific type of person. Can you get woken up at night, 2 o'clock in the morning, because
Horrifying.
pipes have burst or whatever? If you can deal with that, well, right now I think Ilyce will tell us that rents are going up while prices are going down. So yeah, it's a good time to make that trade and buy something and rent it out. But it's not like owning a mutual fund,
right?
You've got to be a very active owner to be your landlord.
And Ilyce, does rental property, I mean, it works. It can still work if you have to hire a management company. It's just that it's not going to work as well. So what do you think about a neophyte getting into the rental market?
I think you have to be really careful and make it as easy on yourself as you can. I've owned rental properties for the last, 10 years. And even when they're really easy, they're rarely that easy.
I like that. Very good.
So I would say make it easy on yourself. Make it a very close to your own house. Wherever you live, make sure it's maybe less than a 15, 20-minute drive, because you're going to want to be there quite often. If you're buying foreclosure, be very careful that there aren't crack houses in the neighborhood, or that the
So that's not good that's probably not good as a marketing. Although you might get a different clientele. Didn't you watch The Wire? They seem to have very nice cribs on that that show.
My second rental apartment ever, we were right across the street from what turned out to be a crack house. So, as a 23-year-old, whatever, it was entertaining. Just the cops would come and take the people away. Yeah. And that was great. But I'm glad I didn't own the property that we were renting. Exactly.
Ilyce, we have a couple more questions, then we have to let you go because you actually have a real life. I know that. Charlie wants to know, is 63 and purchased a house in 2007 for $190,000. Sounds like the top of the market. A house like mine just sold for $125,000. Eesh. I got my property taxes adjusted to $145,000 by the county. I owe $183,000. Oh. Okay, so let's just say house is worth $125,000. You got $183,000. You're upside down in a massive way. And Charlie says, I feel like jumping ship at this point. I'm throwing good money after bad. Has this become the new standard? Too bad, grin and bear it. Should Charlie walk? What do you think, Ilyce? Should Charlie just walk away, trash the credit, and move on?
I hesitate always to recommend strategic default, which is what he's talking about. Some of it depends on whether you're in a recourse or non-recourse state. Most of the states are recourse, meaning the lender can come after you unless you sign off on this. I'd much rather see him try to do a short sale first and get the lender to say, okay, this is it. We're not going to come chase you for the rest of it.
Right.
Or even do a deed in lieu of foreclosure. Certainly, you can just say to the lender, take the house. This is what's in our loan agreement. I don't care. I'm moving on. But it's never as simple as it sounds in the media. And I would be very cautious and talk to an attorney. Understand what your legal options and obligations are going to be before you make this move. Because once you make it, there's no going back.
Yeah.
The only thing, and I would agree completely with that, I would address something that you see a lot, the sense that it is morally wrong to walk away from a mortgage. And I understand why people have that feeling. But the fact is that you signed a contract, at least referred to it, where, essentially the bank owns that house and you're paying the bank back. And if this were a corporate decision, then the corporation would walk away or renegotiate in a second. I mean, don't think that your bank, if your bank owned property that was this far underwater, they would not pay for it in full.
Right, right. I mean, so you can try to negotiate. And Ilyce, I think you bring up a great point also, which is it's a very painful process. It trashes your credit. It follows you for a while. Renters are now being asked for credit reports. So bad credit can hurt you with a rental as well. So I also agree with you, though, Jack. I am so not a moralist about this. You got to bail, and that's the right thing. You went to an attorney. You talked to the people you needed to talk to. Do the right thing for your family.
Yeah, and I'm not suggesting that strategic foreclosure is necessarily a good thing. What I'm saying is I want to take out the moral component and think about it from a practical standpoint, as Ilyce was suggesting, and you were.
Last question from Jana, who's relocating out of state, and she wants to get rid of a house she's owned for over 5 years, but she too is upside down on the mortgage. Here's your question. 1, is there any hope that the market will turn around in the near future? I think we could all agree that no. The market's not turning around in the near future.
No.
And even if it does, it's going to take a long time to crawl. Turning around means we inch back up at 3, 4, 5% a year.
And Ilyce, just one more time, the difference between a short sale and walking away is that the bank basically agrees. With a short sale, you're basically getting the bank to buy in and say, we'll take less for what is owed than what is owed to us. We now will release you. We're sort of giving you papal dispensation. Move on, right?
But you can get hit with taxes.
Right. Although, isn't the tax thing, isn't there a holiday for that? Is that this year?
Yeah, through 2013.
Oh,
actually,
good.
It might be through January 1st of 2013 or December 31st. One of the two I have to look and see. But, yeah, right now there's a tax. You don't get hit with the phantom tax or IRS saying that the difference between what you owed and what you paid back through the short sale is actually income, which the IRS would consider taxable to you, both on a federal and state level, of course. Short sales mean the bank is blessing it, but those were speeding up in the spring, like February, March, April. We were seeing banks, Bank of America even was moving faster on approving those. Now it's slowed way down again, and it's taking 5 or 6 months to get short sales approved. I'm not quite sure what's causing that, but again, there's so many internal conflicts here. FHFA, which oversees Fannie Freddie, is against any kind of a deal for the homeowner. They're claiming they're trying to protect the American taxpayer. They're against it, but the Obama administration's for it, and making home affordable is for it. But the lenders are against it. The investors are for it. People do not have the priorities going the same way, and they don't have the same level of incentives. And I think it's causing a real big muck-up.
Oh, I have one last question that I have to ask. I know, I'm sorry, I lied, but I missed it in the chat room. Chuck wants to know, I'm disabled and I want to buy my first home. Are there any programs for someone like me? So if you're on SSDI, can you qualify to buy a home?
You can. The best program will be maybe a 203K loan, where you get a loan for the property plus another 25% to make improvements to the home. So people with disabilities tend to need to modify their properties. They need to, for example, install ramps. Sometimes they need to install an elevator, whatever it is. Getting a 203K loan, which I think is not actually well known particularly, it's time consuming, but it's worth it. You just have to prove that the investments you're making into the property will actually raise the property value. And that's, while difficult to do, it's usually a good choice.
I'm very impressed that you have 203K, because I just thought that was the value of a retirement plan in April of 2009. So I appreciate you now teaching me something. As always, Dr. Ilyce Glink, who knows everything money.
She's an encyclopedia.
She is like Encyclopedia Brown. Ilyce Glink, thank you so much. Here, lean back and enjoy it, baby. She is an award-winning, nationally syndicated columnist, best-selling book author. Go to her website, thinkglink.com, and go to moneywatch.com, where her blog is awesome. She also has a radio talk show, Expert Real Estate Tips. Where is that, in Atlanta?
The talk show is on WSB Sunday mornings at noon. We're on football time now for the Bulldogs, but shockingly enough, I'm the only one who falls forward in the fall. I have to go forward. But on YouTube, it's Expert Real Estate Tips, and there are 325 videos with a couple of million views, and hopefully you'll get some help out of those.
The woman really, she is a one-woman real estate financial machine. Good luck to your poor son, the toothless wonder of Chicago, and tell him that we understand that Mommy had to be with him. But thank you so much for joining us, Ilyce.
Anytime. See you guys soon.
And Mr. Jack Otter, I feel like when Ilyce is on, we don't have to work. So it's kind of awesome, right?
Yeah,
it's like, well, we decided to...
Do we ever work?
Not on this show.
Okay, no,
not on this show. Doing other stuff for sure.
Yeah.
Now, for all of you all out there watching, chatting, all of that, you don't have to just wait for Ask the Experts. You can send us emails anytime. You can go to moneywatch.com. You can respond to blogs. You can get involved. We want you to be engaged. It's called viewer engagement. We're very hip on that. And if you've got questions, concerns, or you have a topic that you'd like us to cover, feel free to shoot us an email, asktheexperts@moneywatch.com. And thank you so much for watching. I'm Jill Schlesinger.
I'm Jack Otter.
And we'll see you next week for Ask the Experts.
Let's get rich and better.